Okay, so imagine this. Right before the market decides to take a nosedive. Wouldn't it be nice to have a little heads up?
Oh, yeah.
That's what we're going to be diving into today. Some really interesting analysis from Lucas Downey over at Map Signals.
Right?
His latest report suggests we might be teetering on the edge of a dip.
Uh-oh.
And his big money index. This thing is flashing some signals.
Interesting.
You ready to decode this with me?
Absolutely. Let's get into it.
So Map Signals, for those who haven't heard of them,
Right.
they really focus on tracking these institutional investors.
Yeah, the big movers.
The whales.
Yeah.
The ones that are actually moving markets.
The ones that really give us a glimpse into where things might be heading.
Yeah, exactly.
Yeah.
And so Downey's report, this one's dated October 24th, 2024, so very recent.
Very recent.
He starts by talking about yesterday's market action.
Okay.
The worst pullback we've seen in weeks.
Oh, wow.
NASDAQ got hit particularly hard, down 1.55%.
Yeah.
But here's the thing. The big money index actually kind of predicted this dip.
Sir. Downey's big money index, the BMI, it just slipped out of what we call overbought territory.
Okay.
And that's a really crucial signal.
So when you say overbought, help me understand this.
Yeah, so overbought doesn't just mean like prices are high.
Okay.
It means that the demand from those big institutions is exceeding supply to a point where it becomes unsustainable.
Oh.
Almost like a rubber band, stretched too tight.
Okay. So it's just like too much buying pressure.
Way too much buying power.
From those big institutions. And that's not necessarily a good thing.
No, it means things are, it's not sustainable.
Right.
At that level.
Okay. But for those of us who aren't,
right,
staring at charts all day,
yeah,
how does the big money index actually work, like practically?
So think of it this way. When the BMI is above 80%,
Okay.
that's like a yellow flag waving.
Okay.
Institutional investors are piling in, pushing those prices up.
Got it.
But when it drops below that threshold,
Okay.
it's like, ooh,
A little shift.
a shift in behavior.
Mm-hmm.
Okay.
We're getting a little more cautious, easing up on that gas pedal a bit.
So it's not just about the absolute number, but the direction of that trend line.
Exactly. The direction is really key. And that recent dip below 80%,
Uh-huh.
it's almost like a canary in the coal mine. It foreshadowed yesterday's pullback.
So it gave us a little bit of a heads up
A little bit of a heads up, yeah.
that, hey, things might be shifting.
Yeah.
So this big money index gives us a heads up about potential shifts.
Right.
But Downey takes it a step further
Okay.
with these 4 distinct phases of big money flow.
Yes.
And this is where things get really interesting.
It gets really interesting.
These phases help us understand how these institutional investors are behaving
Totally.
and anticipate what might happen next.
Yeah. Each phase reflects a different dynamic
Okay.
between buying and selling pressure from those major players.
Mm-hmm.
And, Downey argues that recognizing those phases is key to making smart investment decisions.
Okay, walk us through it.
Okay, so phase 1, this is the exuberance phase. Yep.
Characterized by tons of buying and very little selling.
Got it.
Think back to early October when the market was surging.
Okay.
Classic example of phase 1, everyone's piling in.
Everyone wants a piece.
Total FOMO.
Yeah. Fear of missing out.
Big time.
What happens next?
Well, like any good party, things eventually start to wind down.
Okay.
Right.
The music slows down a little bit.
That's where phase 2 comes in, buying slows down.
Okay.
And we start to see some selling activity creeping in.
Oh.
This is often when the market reaches a peak, at least temporarily.
So the music's slowing down.
Yeah.
Some people are heading towards the exits, but the party's not quite over yet.
I like that analogy. And according to Downey,
Yeah.
this is precisely where we are right now at the tail end of phase 2.
Okay, so that's a little unnerving.
Yeah.
But you mentioned phase 3 is where things get really interesting.
Yes.
Why is that?
So phase 3 is when the selling really picks up.
Oh.
We typically see a correction in the market, and that's where a lot of investors start to panic. But here's the key.
Okay.
Downey argues this is actually the best time to buy.
Wait, so the time to buy is when everyone else is running for the hills.
It seems counterintuitive, right?
That's crazy.
But that's the beauty of understanding the big money index.
Okay.
Think about it.
Yeah.
When fear takes over and everyone's selling prices drop,
Right.
that's when savvy institutional investors start scooping up bargains.
Oh, so they're using that panic to their advantage.
Totally. They have the discipline and the resources to ride out the storm
Okay.
and capitalize on those lower prices.
This makes sense from their perspective.
Right.
But, for us regular people, it's so hard to fight that urge to sell when you just see your portfolio shrinking.
Right. Well, and that's where tools like the Big Money Index and a solid understanding of these phases can be so helpful. It provides data-driven insights to help us stay calm and think strategically, even when emotions are running high.
So keep a cool head watch for these signals. And maybe even get ready to buy when everyone else is hitting the sell button.
Potentially.
But you mentioned there's a fourth phase.
Right. So phase 4 is the extreme scenario.
Okay.
It's when sellers completely dominate and buyers have vanished.
Wow.
We call this an oversold market.
Like a fire sale.
It's like a fire sale,
Yeah,
and
yeah.
it presents a dramatic buying opportunity. But remember, this is rare.
All right.
Downey points out that the last time we saw a true phase 4 was about a year ago.
Wow. So those who bought during that fire sale probably feeling pretty good right now.
Oh, yeah.
But as we head deeper into Downey's analysis, he actually injects some optimism into the current picture,
Right.
despite the potential for a market pullback.
Okay.
Remember, we're approaching a historically strong period for stocks.
We are.
When is that?
November through April.
Okay.
Downey's research shows that since 1995, the S&P 500 has gained an average of 7% during those 6 months, and the NASDAQ 100 has gained an average of 9%.
Pretty solid track record.
It is a good track record.
But what about the elephant in the room, the election?
Right.
So much uncertainty right now. Doesn't that kind of overshadow everything else?
Downey acknowledges the election jitters. He calls them election tape bombs
Election tape bomb.
that are hitting us daily.
Wow.
But he believes this pre-election volatility is temporary.
Okay.
He sees it as a distraction from the longer-term market trends, which point towards a potential upswing.
So once we get past the election, things could really take off.
That's the suggestion,
Okay.
particularly for a specific segment of the market mid-cap companies.
Mid-caps. Why are those particularly interesting right now?
So Downey highlights that mid-caps historically outperform starting in November.
Okay.
Since 1995, the S&P Mid-Cap 400 has rallied an average of 9.35% during that November to April period.
Wow, that's even better than the S&P and the NASDAQ averages.
It is.
But what makes mid-caps so special, especially in this kind of climate?
There's a couple key factors. First, many analysts believe we're heading into a rate cut environment. Okay. And historically, mid-cap companies tend to thrive when interest rates are falling.
So we've got this potential market pullback,
Right.
but also this historical trend that favors mid-caps in a rate cut environment. This is a lot to consider.
It is a lot to consider, and navigating these waters can be tricky.
Yeah.
That's why map signals and tools like the Big Money Index are so valuable.
Okay.
They help us cut through the noise and identify those under-the-radar mid-cap companies being quietly accumulated by institutional investors.
So they're like these scouts uncovering these hidden gems before everyone else catches on.
That's a great way to put it.
This is really fascinating.
It is.
So they can help us find the right companies.
Yeah.
But how do we know when to buy? Do we just like sit tight and wait for the market to just bottom out?
So that's where the art and science of investing come together. There's no perfect formula or foolproof timing strategy,
Right.
but the Big Money Index can give us some valuable insights.
So we watch the BMI, look for those phases that Downey's describing, and then what?
And then we do our own due diligence.
Okay.
We research the companies that Map Signals highlights. We analyze their financials.
Oh.
We consider our own risk tolerance and make sure our investment decisions align with our personal goals.
So it's not just about blindly following the herd
Exactly.
or chasing the latest hot stock tip.
You're absolutely right. It's about combining those data-driven insights with your own judgment research
Right.
and a solid understanding of the market forces at play.
So in a way, we're being empowered to think like these institutional investors.
Yes.
To kind of read the tea leaves and anticipate these shifts in sentiment.
Precisely, the more we understand how these tools work,
Yeah.
the more confident and informed we become as investors.
This has been incredibly insightful.
It has.
We've gone from market jitters to mid-cap opportunities
We have.
to learning how to read these subtle signals from the big money.
Yeah.
But before we wrap up, there's one more thing I'm curious about.
Okay. So let's go back to those mid caps for a second. You know, why Downey thinks they could be poised for such a strong run.
Yeah.
We've talked about their historical outperformance, you know, that November to April period.
Right.
But it's important to understand why that trend exists.
Right. It's not just some random quirk of the calendar.
Exactly.
Yeah.
There has to be some underlying logic, you know, driving that performance, especially if it's been consistent for so long.
Yeah. What is it?
One theory is that it's tied to how institutions manage their portfolios.
Okay.
Many of them do their rebalancing towards the end of the year, which can lead to increased buying activity and mid-caps.
Right.
With their blend of growth potential and stability, they often become appealing targets.
So it's partly a matter of timing and how these big players allocate their capital.
Yeah, all about the timing.
Makes sense.
Yeah.
But you also mentioned these anticipated rate cuts as a factor favoring mid-caps.
Right.
Can you elaborate on that a little bit?
Absolutely. So remember how we talked about overbought conditions being a sign of unsustainable demand?
Yeah.
Well, interest rates play a huge role in that whole equation.
Oh.
When rates are high,
Right.
it becomes more expensive for companies to borrow money and invest in growth. And that can really put a damper on overall economic activity.
Okay, so when rates are cut, it essentially becomes cheaper for companies to do business,
Yeah.
which can then boost their growth prospects.
Yeah.
But why do mid-caps in particular benefit from this kind of environment?
So they often occupy the sweet spot in the market.
Why?
They're not as vulnerable to interest rate fluctuations as smaller companies that rely heavily on debt.
Okay.
But they're also not as entrenched and slow moving as those massive corporations.
Right.
That can take ages to adapt.
So mid-caps have this agility to capitalize on a rate cut environment more quickly.
Yeah.
Not too big, not too small.
Just right.
That Goldilocks scenario.
The Goldilocks scenario, yeah, they have the growth potential.
Yeah.
That gets unlocked when borrowing becomes cheaper. But they're also established enough to weather any kind of short-term economic bumps in the road.
This is all starting to make a lot more sense.
Good.
So we've got these historical trends favoring mid-caps.
Right.
We've got this potential rate cut environment
Yeah.
that could further boost their performance. And we have map signals tracking the big money to pinpoint which companies are attracting that institutional interest.
Yes.
But Downey's report doesn't just focus on mid-caps, right?
That's right. He also acknowledges the election as a major factor looming over the market.
You mentioned earlier that he calls them election tape bombs,
Yes.
which sounds pretty dramatic.
It does sound dramatic.
How does he actually see the election impacting things?
So he acknowledges the uncertainty and the daily barrage of headlines.
Yeah.
But he ultimately views this pre-election jitter as a temporary phenomenon.
So just kind of a short-term distraction from the bigger picture.
Exactly. He believes that once that election dust settles, the market will refocus on those underlying fundamentals. And those fundamentals, especially considering the potential for rate cuts, they look pretty favorable.
Okay.
At least according to his analysis
Right.
and the signals from the big money index.
So don't get spooked by the headlines.
Right.
Focus on the long game.
Yeah.
But let's be real, for the average investor, this can all feel pretty overwhelming.
Yeah, it can be a lot.
How do we actually put this knowledge into practice? How do we identify these promising mid-cap companies that are kind of flying under the radar?
So that's where Map Signal's expertise really comes in.
Okay.
They've developed a system for tracking those buying patterns of institutional investors, using that data to pinpoint companies that are showing signs of strong accumulation.
So they're like stock market detectives,
Yes.
following the trail of breadcrumbs left by the smart money.
I love that analogy. They're sifting through the data,
Yeah.
looking for those subtle clues
Yeah.
that suggest a company's being quietly scooped up by the pros, even if it's not making headlines yet.
So it's not front page news.
No.
This is fascinating.
It is.
So they can help us find the right companies.
Right.
But how do we know when to buy? Do we just sit tight and wait for the market to bottom out?
So that's where the art and science of investing really come together.
Okay.
There's no perfect formula
Right.
or foolproof timing strategy,
Yeah.
but the Big Money Index can give us some valuable insights.
So we watch the BMI, we look for those phases that Downey is describing, and then what?
And then we do our own due diligence.
Okay.
We research the companies that Map Signals highlights, analyze their financials,
Yeah.
consider our own risk tolerance, and make sure our investment decisions align with our own personal goals.
So it's not just about blindly following the herd
Right.
or chasing the latest hot stock tip.
You're absolutely right. It's about combining those data-driven insights
Yeah.
with your own judgment, your own research,
Right.
and a solid understanding of the market forces at play.
So in a way, we're being empowered to think like these institutional investors,
Yes.
to read the tea leaves
Yeah.
and anticipate these shifts in sentiment.
Precisely, the more we understand how these tools work, the more confident and informed we become as investors, and that's the real power of this approach.
This has been really insightful.
It has been.
We've gone from market jitters and potential pullbacks
We have.
to exploring these mid-cap opportunities and then broadened our view to consider these other promising sectors.
Yeah.
And through it all, we've kind of learned how to read these signals from the big money, which I think is incredibly valuable.
Absolutely. It's been a pleasure unpacking all this with you.
Absolutely.
Remember, the key takeaway here is to stay engaged, stay curious, and never stop learning.
Couldn't agree more.
There's always something new to discover in the markets.
So as Downey suggests, let's make sure our buy lists are ready.
Yes.
Let's hope we're all well positioned for that next liftoff phase. So thanks for joining us on this deep dive. Until next time.